Take it away, Ted.
Good afternoon, everyone. My name is Ted Bulow. I'm the Tribal Coordinator for USDA Rural Development, and it's a pleasure to be with you today. Thank you to OWISTA for hosting the Native CDFI Access to Capital Convening again, second time virtually, but it's always a pleasure to be involved. Last time I was involved personally as a presenter was when we could meet in person. It was 3 years ago. I was fondly remembering my time in Central California with many of you, including co-presenter in that session, Mr. Ted Piccolo. So nice to see his name on the attendee list today. 2 years ago, I sent a colleague who is now one of our presenters, supervisor, Mr. Sammy Zarar, went 2 years ago to the Native CDFI Capital Access Convening in Hawaii. I was sad to miss that event, but I was glad that many of you could meet Sammy and interact with him, and he did a good job representing the agency and talking about our business programs. Sammy's still with the agency, but David Chestnut, our branch chief, is going to present today on Rural Business Programs' behalf. And then, of course, last year was unique in that the convening switched to virtual in difficult circumstances. So I'm glad all of you have persevered. I'm sure it's been a year of stress and loss for some, if not many of you, if not all of you, because it's certainly been quite a year to 18 months since we've all been dealing with the pandemic. So we're here, we're still plugging along, and we're really happy to be involved in today's session. I want to give a chance to each of our presenters to introduce themselves at first. Then I will talk about how the session will be formatted and what we'll cover today. And then we'll get into our first presenter. But let's start with Dave. If you could introduce yourself, then Kendra, then Macy.
Oh, thank you, Ted. Thank you. I'm David Chestnut, and I am the branch chief for Rural Business Cooperative Service Intermediary Programs, as you can see on the slide. Sammy Zarar still talks about going to Hawaii. He is my boss in the Program Management Division. So Sammy and I have many conversations, and I'm based in Alexandria, Virginia. I work out of the national office in DC. But again, over the last 18 months, been working virtually. So my staff conducts and administers the programs, and we have 7 programs under my purview. And I just wanted to share that with you. And thank you for the invitation.
Thank you, Dave. Kendra?
Good afternoon, everyone. I'm Kendra Harmon. I'm a finance and loan analyst in the lender and partner activities branch of the Single Family Housing Guaranteed Loan Program. So I'm here to do a presentation for any of you that may be interested in becoming a guaranteed lender in our single family housing program.
Thank you. Macy?
Hi everyone, my name is Macy Rouse. I'm a Pathways student trainee in Tribal Relations with Rural Development's Innovation Center. Currently working from North Carolina, where I'm also finishing my master's degree. I will not be presenting because I'm fairly new, so just here to listen and learn. Thank you.
And thank you to the team for collaborating on this and for participating today. So what we'll try to do is Dave's going to give an update on a few of our intermediary programs that he and his team administer. 2 of those we've talked about in the past, the Rural Business Development Grant Program and the Intermediary Relending Program. Some of you have used or tried to use at least one or maybe both of those programs in the past. So if you want to interject with questions, there'll be time at the end of each program that he covers to ask questions and provide some experiences that might help your peers that are also in this session with us. Then after we go through that, that'll be about half of the session we're planning, so 45 minutes or so. Then we will shift gears kind of sharply. I guess we'll turn the wheel and we'll make a sharp left turn. It's hard to shift gears sharply, so I apologize for mixing my metaphors. But we'll then talk about becoming an approved lender in our OneRD program, which we've chatted with Native CDFIs before about, as well as in our 502 Guaranteed program. We'll have a couple of updates, but we also want to sort of go through how that process stands currently. And there'll be time for discussion and question and answers after those presentations as well. So without further ado, I'll hand it back to Dave and Dave, I'll forward the slides when you tell me to, and we'll walk through the intermediary programs.
Very good, Ted. Thank you. Thank you very much for the introduction and how we're going. So again, thank you very much. I hope all of you are healthy and survived and are surviving pandemic. And from what I understand out west, the heat that's coming in. But if you want to go to the next slide, Ted, we can start this process. The first one I want to talk about is the Intermediary Relending Program, IRP. Essentially, we're loaning money to intermediaries to make loans to businesses in their area and their region. The primary goal is to retain and create employment in rural areas. So we are loaning money to the IRP intermediary. When we look at an IRP intermediary, we just want them to exhibit repayment ability. In other words, it is a loan from the agency to the intermediary. They should be able to administer a loan program and have a need for loans in their service area. We do have a maximum loan amount of $1 million. You don't have to apply for $1 million. If you feel that the need in your area over the next year may be in the $500,000 range, for example, or any number that you choose, you can apply for that loan in there. There is an aggregate loan limit to one intermediary of $15 million. So you don't have to apply for the maximum every time. Apply for what you need to go from there. Next slide. So the intermediaries we look at, most of ours are nonprofit corporations or public agencies. We do have Indian tribes are eligible IRP, and we do have several tribes that have intermediary programs or cooperative. And the loans, the interest rate that we provide to you is 1%. That rate is fixed for 30 years. The reason we do that is so that you can, in your loans to businesses, charge still a very, very good rate, but still have an interest rate spread that you can replenish into the intermediary relending fund or revolving loan program and make additional loans. In the payment structure, you have to pay interest-only payments for the first 3 years. And then at the end of 3 years, we'll take the loan amount, in other words, the amount that you borrowed, and amortize that through equal payments on an annual basis over the next 27 years. Next slide. I will say that, when we charge interest only, if you're out making loans, you're basically gathering their principal and interest payments back to you. So kind of building an nest egg for you to make payments to the agency. We do accept applications for this program on an ongoing basis. We do compete for program funds and available funds on a quarterly basis. Those being the federal fiscal quarters at the end of September, January, March, and June of each year. And also we do have a reserve funding for Native American intermediaries. The qualification for that is where the funds, minimum of 75% of the funds will be loaned to businesses located on tribal lands. We do have for these reserve funds an application deadline of May 31st of each year. And if you miss that May 31 deadline for the tribal reserve funds, just submit it and we'll put you in the regular funds program. But the IRP program set aside for these projects that benefit members of tribes, we do want to have that available. We funded one project for $500,000 in FY 2020, but unfortunately this year we did not receive any applications for the tribal funds for that program. So we want to get the word out to you that they're available, they're there. If you want to apply for tribal reserve funds, please do so. Next slide. So the IRP program, we have gone for 2 years, trying to basically reinvigorate the IRP regulation to current updates. The last time the regulation was updated was somewhere around 2008. So the Farm Bill of 2018 required some specific updates to the IRP program. Those updates include a loan limit to ultimate recipients, the ability of an intermediary to get some of their equity back, and also expanding the service area definition. I will caution that until the regulation is published, which it currently is at the Undersecretary's office, until that regulation is published, these changes that I'm going to talk about in the next slides really aren't effective until that date, but we know they're coming. Go next slide. So we're going to change the loan limitation. Currently, we can only have a maximum of $250,000 loaned from your revolving loan fund to any one business. That's going to be changed to where we'll allow the maximum loan amount to $400,000 or up to 50% of your approved loan to the intermediary. So we don't want all of your loan funds going to one borrower. So we take a look at that, but you can loan up to $400,000. So that includes the unpaid balance of any existing loans to that ultimate recipient. So 400,000 could be in one loan, could be in several loans. And then when I talk to lenders about this, recognize that the IRP loan is a obligation of the intermediary. So we want you to have the good underwriting skills, and especially in these larger loans. I was in banking for 30 years, and I know that no matter how hard you try, the loss is always hard to make up with interest to recover. Next slide.
Hey, Dave, we got our first question.
Yeah, sure.
It's time specific to the new reg. If we already have an IRP in place and the changes come, will they affect us as well? Are they retroactive, or how's that work?
Yeah, you would just, we will have an opt-in form on our website to where you say, yeah, I would prefer to operate my program under the new regulation at that point. So you're sort of automatically grandfathered in. If you were to make a new application, you would be under the new regulation or the revised regulation, but there is an opt-in form.
And you didn't, this wasn't the question, but it raised the question in my mind. Is there an opt-out then? Or are you automatically opted out and not grandfathered in?
You're automatically opted out. Automatically opted out if you don't opt in.
Gotcha. Thanks.
Yeah.
All right. Thanks for the question, Ted.
Thank you. This is a new one that we had to work with and really read through the Farm Bill and the manager's report and what they really wanted us to do as far as returning equity from the revolving loan program. This was not allowed and is not currently allowed. So a lot of people may opt in just for the ability to get their equity funds back. We call it when they have revolved funds, where the cash portion of your revolving loan fund includes fees, principal and interest payments that you've gotten back from the ultimate recipients. It's not comprised of any original IRP loan funds. You can request a partial or a full return of your equity. What we're looking for in this return of equity is that, number one, you're current in all your payments to the agency and you've got all your reporting requirements done. I know that every one of you do that. But also we want the ratio of intermediary equity to the loan after the return of equity be consistent with your initial equity percentage. So if you put in 20% of your funds into an intermediary loan into that revolving loan fund, if you pull out some equity out of that loan fund, we still want your equity to be equal to 20%. There are some intermediaries, because this program's been in effect for over 20 years, that the amount of their equity in that program, due to the return of interest and fees, et cetera, they've got some 35 to 40% equity in the revolving loan fund. So I think those are the ones that requested Congress to make that change. And we certainly understand the return of equity. And also we have to approve that return of equity. So you just make a request to us in writing. And we want to make sure that we're not causing additional credit risk to the revolving loan fund or to the agency by a return of that equity. So it's something you request from us. We take a look at where your equity is in the fund and go from there. Next one. In a service area definition, this may impact you a lot greater than some might imagine, but currently the IRP regulation has a 14 county service area limit. So that's gone away. So we no longer have a service area limitation. We're going to rely on our intermediaries to tell us what their territory is, where they're going to be at. But we want to discourage national lenders, so to speak, and the proviso is that we want you to demonstrate that you've got a governing or advisory board who represent the communities that you're going to serve in your service area. So 14 counties, that's really easily done. If you go and expand broader than that, we just want to make sure we understand that you have representatives and who know the community, what those needs are in that community. Next one. The loan purposes, we updated some of that to clarify some eligibility. Agricultural production is still an ineligible purpose for your loans to ultimate recipients. But always, we had allowed aquaculture, hydroponics, commercial fishing, nurseries, forestry. We now clearly just stated that those are eligible for the program. Eligible use of housing projects is better defined. It's related to community development. So basically, if you want to loan money to a contractor to develop a subdivision or to help out with some housing, community development type purposes, that's okay. But you still can't use funds to purchase residential property. You can't do it for buying properties for any reason, whether it be to own and live in it or to buy it and swap it out from there. Next one.
Yeah, before we go, I just wanted to, I don't think I need to ask you, but I'll describe a little bit value-added production, because we have another program which you may or may not have heard of called the Value-Added Producer Grant, which is a direct to ag producer program. So the CDFIs, or Native CDFIs, might not be aware of that program. And similar to that, this definition allows for on-farm small businesses that would be adding value to a commodity like beef or lamb or corn or whatever a ag producer might be producing, so that they retain more of that value in their own pocket. They can sell directly to customers. So would you add anything else to that? Because I think those types of individuals are the customers of Native CDFIs.
Right, and then that's a good point, Ted. Yeah, VAPG is its own separate program, which is a grant, but as an intermediary, you can loan to someone on farm. A lot of it, Midwest is converting fruits into jams. You can, if you wanted to do a beef processing or start a small processing facility on your cattle ranch, for example, that IRP funds could be used for that. In Virginia, a lot of wineries. I think Wisconsin does a lot of cheese up in that. So if they want to do cheese processing from their dairy, those are examples of value-added production that you as an IRP intermediary could fund to businesses. I think, was there another question that just popped up about?
Yeah, it looks like there's two more. So I was going to add one other thing, which I'd never really contemplated before, but one of the challenges for tribes and for tribal member ag producers with the Value-Added Producer Grant Program is that it has a matching funds requirement of 1-to-1. So most often in our programs, and I assume IRP is the same, you can correct me if I'm wrong, David, but that money that you would lend to that ag producer could then also be used as match. So if there's affordable ways to partner on those applications, it doesn't have to be for a value-added producer grant. It can be for any value-added production activity that a small business might have or a farmer-based business might have. But there might be opportunities to actually partner with that RD program so that the folks don't apply because they don't have the match.
Right. And, they can be matching funds because you're loaning to that ag producer to do that. And when you look at, again, we talk about value-added production and loans to businesses. They don't have to be established businesses. You could be someone starting a business. It could be someone starting a process for value-added production, or they need inventory or other things. So that's a good point.
So we did get a couple questions about farming. So could the loan be used to start a farming, ranching, fishing business? Per David's comments, it depends. Fishing is different than farming, and value-added production is different than farming. So generally, no, I would say, but there are areas around there like commercial fishing is an eligible applicant, ultimate recipient, I should say.
Yeah, commercial fishing, and that tends to be around the rivers and coastal areas where you actually have a commercial boat goes out and does fishing. Aquaculture, I know there are a lot of catfish farms in the Midwest and the South, and farming for aquaculture, things of that nature. for
And
those
it's a
programs.
particularly big opportunity in the
Yeah.
Pacific Northwest and Alaska too. So next question, I think, is also a yes, but Ted, so I have a local guy who purchased an old school site and has a plan to develop all of that into homes. My RP funds are eligible for lending to him for the construction of those homes, for the business construction of it.
He can do the construction. He can't own the, he can't be the owner and residential. And so if you want to loan money to him for some expenses for the construction and development of the housing sites, yeah.
And oops, I was trying to scroll down on the chat and I scrolled the slides. So when we get back to the slides, make sure I'm on the right one. Next question, to clarify, a loan can be made to a builder to develop a subdivision. The loan limit is 1 million. What if the cost is more? So
yeah, so there is some project equity involved. The IRP fund, you can't loan them. You shouldn't loan them more than 75% of the project costs. When we say the loan limit's $1 million, that $1 million loan is to the intermediary. The intermediary is then making loans for that subdivision development. And currently the loan limit to that developer is $250,000.
And that's what you said will go up to 400 when it's.
We'll go up to 400 after the regulations published, but not more than 75% of the project costs.
And
as
last
well.
question.
The other part is, as an intermediary, and this as CDFI lenders, you've got collateral in that base as well. So you need to make sure you're adequately secured. We're relying on these intermediaries to have the knowledge and skills to run a loan program. And that includes documentation of collateral and secured positions and ability to do a credit analysis on who your borrowers are. Because as I mentioned, it's loan defaults are the primary cause of servicing issues we have in the IRP program.
Last question is a clarifying question, and it was back to the farming or ranching or fishing. So hopefully you understand there's only so far we can go into farming and ranching. We basically can't do ag production, but we can do businesses that might add value to that commodity for a farmer or a rancher. But the question was, can they start, can the intermediary lend to new businesses, or do they have to be established? And
they can be
new or established.
Right.
Great. Well, we're going to stop there for questions. I'll keep an eye on the chat, but we also don't want to run out of time. So do I need to go back, David? Where were we?
I think we're good. We're in ineligible loan purposes. I think we're good there.
Did we get through the? Yep, we did.
Yeah, we did.
Okay. Thanks.
Ineligible, we did clarify some conflict of interest definitions and prohibitions, updated so we're matching other business programs in there. If you are a tribe, you basically can't loan to yourself. From there, I guess, is a clarifying in conflict of interest from there. But if the tribe owns a business that is operated independently as a business and has our own management and board and is separate, it's an entity of the tribe, but clearly separate, you can loan to that business. So there's some conflict of interest things in there. Also, we used to have a 10% provision or limitation on what could be derived from gambling proceeds. There's exclusions for state authorized lottery proceeds and tribal authorized gambling proceeds conducted to raise funds for the approved project. So this comes about as it's kind of a consistent thing, but we raised the threshold from 10% to 15%. That would make an entity ineligible to be an intermediary or business from there. Next. We disperse IRP funds, so you may apply for $1 million loan or $500,000 loan. So we disperse those as needed. You got to sign a loan agreement and promissory note. You can only request funds needed to fund an ultimate recipient project. And we eliminated the ability to cover a 30-day work plan. But if you have a loan that you've committed to and you're going to close that within the next 30 days, we can make that disbursement to your account prior to that loan closing, so you have the funds on hand. And also just a reminder that equity contributions that you put into the revolving loan funds you can't be use those for your administrative costs in there. So you can use some of the interest and proceeds to cover your administrative costs, and you can also charge fees for your loans to your ultimate recipients. Okay. And slide in for questions. So I don't know if you want to have other questions regarding the IRP program. I didn't see anything else pop in. And if not, we can go on. Rural Business Development Grant, one of our...
Hold on just a second, David.
Yeah.
There weren't any in the chat. I was trying to come off mute.
Oh.
But does anyone, we can take one question via audio if anyone has a question or a comment about IRP before we go on to RBDG. Any takers? Hearing none, let's go on.
Okay. I want to talk about Rural Business Development Grant, RBDG, one of our most popular programs, and it's very popular because all of the funds, $28 million this fiscal year, we pretty much allocate to individual states. So they have those items in RBDG. Basically, the purpose is to provide technical assistance and training for rural small businesses. When we say small businesses in RBDG, that's you're creating less than 50 new workers and the business has less than $1 million in gross revenue. We do have applicants being nonprofits, tribes, public bodies, and public institutions of higher education. We do reserve funds for projects that benefit members of federally recognized tribes. This year, we just finished our funding of the Tribal Reserve Fund. We did 32 projects. Of the 32 projects, we had 3 revolving loan funds that were set up by tribes to help out businesses on their tribal lands. We had, most of them were for technical assistance and training for businesses located on tribal lands that they're doing. Some of them, we had a couple of them that were buying equipment for a business and then leasing it to that business, which can be done with an enterprise type grant, to where I think this one, they're purchasing equipment for a business and then leasing it to that equipment. And the lease must be a market lease, so to speak. You can't buy it for a business and lease it to them for $1 a year. I mean, the business has to pay you back and lease it to them for that project. But those were some of the purchases we saw. These are in the tribal grants. Last year, we funded a total of 406 grants from a regular program, and from Native American 29 grants over 13 states. So we're very proud of that award and very proud of those projects. Next.
And this is a good question for RBDG, but we had a late breaking IRP question from Leslie. I think I understand your question, Leslie, but if we don't get it exactly right, let us know. But her question was, what are the steps basically to become an intermediary? So how is an entity eligible? Let's start with IRP. How do we receive an application from them and deem them to be eligible of that assistance?
All the application materials and everything, or you can basically, the easiest way is to contact your state office and get information from them. They probably guide you to, there's an application template. There are materials on our website. If you went into rd.usda.gov under business programs, the Intermediary Relending program will take you to that site where they have all the application materials. But in order to be eligible, the eligibility requirements, if you are a tribe, if you're a nonprofit entity and you have the ability to manage a revolving loan fund and provide some information, including your financial statement, all as dictated in there, that's where you go. So your first stop would be the website and or the state office.
And just to add a little to that, so when we look at your ability to be the financial aspects of the ability to lend, we also look at your organizational documents, so your charter, how your board is structured, as well as your lending guidelines. There needs to be guidelines in place, and that's part of an application, which is also a requirement if you're going to use a rural business development grant for a revolving loan fund. So we'll look at those documents. But basically, we don't require you to be an approved intermediary for this program before you apply. That would all be done through your application process. So really the first step is applying for the funds and then following the guidelines on what we would need to document you as a eligible intermediary. So
Yeah, thank you. Yeah, and that's exactly right. And, you know, there are a lot of intermediaries out there. I think we have 350 across the country, and I think OWISTA would be a great resource to talk to other IRP intermediaries and or what they've seen in the IRP program, as well as RBDG. Go on to the next one.
We'll go on to the next slide. Ted, I see your question, but I know that David answers the question about the application window here in a later slide. So
Okay. Yeah.
Hold your horses on that one.
Yeah. Thank you, Ted. Yeah, RBDG, there are two distinct purposes. RBDG about 10 years ago was a merger of Rural Business Opportunity Grant and the Rural Business Enterprise Grant. They put it into one regulation. Opportunity funds, if you look at it from just a 30,000 foot view, opportunity grants, opportunity funds are more broad-based, provide support projects for technical assistance, business development, economic development planning. So if you're doing some technology-based economic development, community feasibility studies, business plans, feasibility studies for a community, so it has a wide scope. And the opportunity funds are always less than the enterprise funds. By statute, the total amount that they appropriate for the RBDG program, whatever the total amount is, 10% it goes to opportunity funds. So 90% of the RBDG program is in enterprise funds. And enterprise funds have a wide scope of purpose, but they're more directed to a specific business or a specific area of a community. They can finance, develop small and emerging businesses. You can use these for construction, acquisition, equipment, and you can also capitalize revolving loan funds, as Ted mentioned in there. So if you're going to use it for a revolving loan fund, you as Ted mentioned, need to have the ability to administer a loan fund, not only from a bylaw standpoint, but also from an expertise. Who's going to be reviewing your revolving loan fund applications? So examples of this, you can acquire and renovate a building for a business, purchase equipment for a business, do feasibility studies as well for a specific business, do some training and even run a rural business incubator through RBDG programs. Again, these are more directed to a specific business. Next. We evaluate application based on, job creation at a local business, how much non-federal funding are you committed to the project, consistency with economic development priorities. We don't want to put a cattle ranch in the downtown area of a small town, a dairy facility or whatever in there. It does have to be a business purpose and not agricultural production, I'm sorry, in there. But each year we publish a NOSA, Notice of Solicitation of Applications. As a matter of fact, we're just had a meeting today about the FY22 Notice of Solicitation of Applications. So we will identify some of that, including agency priorities in there. Next slide.
I was just going to mention with the percent of non-federal funding committed to the project, there is no match required in RBDG. We've seen projects, especially in the set-aside, the tribal set-aside, that get funded without match, but you'll be competing against the other Native American applicants for that set-aside funding. So as you do get more match or other funding that's committed to fully fund the project, it will help. But just know that that's not a requirement in the program, but it will impact your scoring and it could impact your ability to get a grant. And if you're competing for the non-set-aside funds, which all of our set-aside funding, if it's not funded and it's eligible, does compete with what we call the state allocation. Most of the times, if there's not match, you're going to get out-competed by the other applicants in the states because those funds are very, very competitive and very small. So
and
that context.
Yeah, and the scores in there, as you say, you give priority points based on how much of the project you're asking the federal government to fund, as opposed to how much money you're putting in from there. But scores you can score up to 240 points in a RBDG application. So, and that includes, well, basically 190 points is the maximum from the state level. So if you can gain 10 or 20 points by putting some of your money into the project, could make a huge difference in getting there. I will say that, you know, we love to see high scores. We love to see projects in those areas, but it's all quantitative. It's all also explained in the NOSA that we put out. There is no maximum grant amount. We do give smaller requests higher priority through the scoring as well. And this, you know, gets to what we've been talking about. There's no cost sharing requirement, but you do get a higher score for putting some funds into the project. The grant term for RBDG is 1 year. All projects should be completed within that time frame. Actually, we do not accept applications where you're going to be using those funds over a 2-year period or period longer than 12 months. Although we do state that you are allowed to have an extension of up to 1 year under justifiable conditions. Certainly COVID was one of those. We had a lot of those requests last year due to COVID related issues. So it's a 1-year grant. Your project should be completed with in 1 year, but we're flexible and will allow additional time if something happens. As I mentioned, we're working on fiscal year 22. That will have an application deadline of February 28th, which is a Monday. That date works out well, and we want to have a consistent date for these applications. I know in previous years, it's been scattered from state to state. Some had a January date, some had a March date. So we want to make it just a standard across all states that February 28th will be the application deadline. This includes those funds reserved for tribal and other persistent poverty applications, Native American persistent poverty applications. We even have a SECD, Strategic Economic Community Development reserve fund. So all of those projects, regardless of its regular funds or set aside funds, February 28th is the deadline. All the funds are obligated. When we get into the Native American funds and all the set aside funds, all those need to be obligated by June 30th. So when you get that application in by February 28th, we promise to get those obligated, the reserve funds obligated, hopefully, and out the door by middle of May. Next.
Yeah, I was just going to add, so folks get a feel of the size of the awards. The tribal set-asides tend to be larger than the state allocated funds because there's less pressure, less applicants. The opportunity type grants that David mentioned tend to be smaller, like in the 50,000 range. They can be bigger, but 50,000 is kind of how I would start your assessment on where an opportunity grant might compete and be funded. The enterprise type grants, especially for revolving loan funds, sometimes people squirm when I say this, but we've seen RBDGs up to $500,000 for some revolving funds and for other eligible projects within the set aside. I have not seen the list of this year. Dave gave you a preview. Those awards aren't public yet, so we can't say who got what. So I don't know if there's any that are that large, but on average, we probably do 30 to 35, and this year seems to fit right in that sort of size category. Number of awards through the RBDG, through the tribal set aside, so that's usually around $4 million. So you can do the math on how that pans out, but they're usually in a range from like $25,000 up to $500,000. I've never seen one that's larger than $500,000. And like I said, if you cascade into that, those funds that are allocated to your state, the likelihood of getting a larger award drops off. So those smaller awards get funded much more easily through that state allocation.
Yeah, we had a little over 3.5 million available in the enterprise funds for Native American this year, and we used all that money. You know, just kind of looking.
Dave, one specific question, especially for Native CDFIs, how's the grant term 1 year? I mean, the loan fund is funded in perpetuity, so they can use those funds, but how's that measured in an RBDG annual cycle if they use it for a loan fund?
Well, that's a good question, but basically we want you to set up that revolving loan fund within that 1-year grant term. So the funds go into perpetuity when you establish a revolving loan fund from there. So when we say 1-year term, you know, establish a revolving loan fund, purchase your equipment, you know, start conducting and working on your feasibility studies within that time frame. Honestly, from a loan, a grant servicing provision, you know, we have to follow 2 CFR 200 and all the servicing. So we've been servicing RBDG grants that are 20 years old because the funds were used to buy a piece of real estate. So our offices have to go out there on a regular basis and just make sure that the property's still there from there. Also, I will say that when you use a grant to purchase equipment, there is a recovery component outlined in 2 CFR 200. So yeah, generally, if the value of what you've purchased is less than $5,000, we don't look at recovery. But if you buy a $300,000 piece of property and our funds were used to fund 75% of that project, when you sell that property, we're going to want 75% of the proceeds, as an example. So we service those to perpetuity, but it's a good question. Yeah, establish your revolving loan fund in that first year, purchase that equipment in the first year.
I don't see any questions in the chat, so if you have some, why don't you pop them in there? But I think RISE is next, David, and we're running a little short on time.
Okay.
I really do appreciate the conversation and the questions. So
yeah, I'll go into RISE. RISE is brand new. And next slide, Rural Innovation, Stronger Economy. This is one that Capitol Hill's been very interested in. They put it into the 2018 Farm Bill. The applicants are Jobs Accelerator Partnerships. The primary purpose is to create high wage jobs in a region. So basically an applicant's going to define what the region is. They're going to look at partnering with another entity. Eligible entities include tribes, nonprofit entities, public bodies, community development organizations, things of that nature. So we want applicants to have that community development experience, but the primary purpose is a creation of high wage jobs. We can scroll through slides, but the unique thing about RISE is that you can also use it to build an innovation center. You can use it to construct an innovation center. The codicil there is that new innovation center has to be located in a low-income community. That's basically where it is. So here's your, eligible entities, a partnership. You can have a partner, governments, land grant colleges, universities, nonprofit cooperatives, even private entities, private development entities. But we need a lead applicant, and the lead applicant's the one who's going to do all the reporting to the agency and sign the grant agreements and do all of those things. So a tribe, subdivision of a tribe, consortium of tribes can be a lead applicant. Next slide. Has to be formed on or after December 20th, 2018. When you do partnerships, that's the date that the Farm Bill was signed. So that's why it's in there, but it's in the statute. Your entity can be older than 2018, but the partnership between you and another entity, and that can be as formal as you want it to be. We're not looking for a 60-page partnership agreement. We're just looking for agreement between parties on separation of duties and how the grant funds will be administered. You should have enough close collaboration among the members. We want a RISE grant, to have a majority of communities in the region that are rural, low-income community, and they have a plan to achieve broadband service. Has 50,000 or fewer applicants. Next one. RISE is also different. They put in the Farm Bill that it's a $500,000 minimum up to a $2 million maximum. So that got a lot of attention. We had a RISE public webinar yesterday. We had over 800 participants on the call. We had about 1,100 people registered. So go from there. I think it's a lot of interest, and it's going to do a lot of good. I think, RBDG grants, as Ted mentioned, we see very few up to $500,000, and in general, the enterprise ones are in the $100,000 to $150,000 range as a high end. RISE grant can cover 80% of the project costs. You can use up to 10% of the grant funds for your administrative or indirect costs. And the grant is for a term of 4 years. So when you make an application, have a 4-year plan on how you're going to use the funds. Next one. The application for this is only open until August 2nd through grants.gov. There's only one application per year. And again, the 20% matching funds. I will also say that the regulation for RISE published on August 15th, and that is in the Federal Register. We opened it up for 60 days of comments. So those comments are due by August 16th through the Federal Register. Next.
It was published June 15th, right? I think you maybe.
Oh, June 15th. Yeah, I said August 15th. I'm looking at it. Yeah. Thank you, Ted. Published
Yep.
June 15th. And next, questions on RISE. We've got a lot of questions, and like I said, it's a lot of interest, and it seems more complicated than it really is. I mean, you're in economic development, a CDFI, nonprofits, or partner with another entity. Look at industry clusters. You know, if you're out in an area that has a specific industry and they need training to get more employees, you know, my wife's in human resources, and you know, there's a lot of need out there for high skilled people, high wage. When we say high wage jobs, we look at the region to where you're at. What's the median wage in that region as defined by Department of Labor? And if you're training for jobs that pay more than that, you're meeting the criteria for a high wage job. One program that, before we move on, I just want to mention, we have Rural Micro Entrepreneur Assistance Program, RMAP as we call it. It doesn't have a tribal reserve funding, but we have plenty of funds available in that program. And it operates like a miniature intermediary relending program, because the maximum loan amount to an intermediary is $500,000. And we also have a grant component to that, to where you can conduct technical assistance and training along with that. So it's a great program, and you can send emails to myself or Ted or any state office and get information on that. Other questions on these, Ted?
Yeah, well, let's let you take a drink, well, this is where we change gears and talk about OneRD. But does anyone want to come on camera or off mute and ask a question or provide a comment about any of the intermediary programs? Now, these programs that Dave manages, they're all intermediary programs. That means we're financing an entity that then, either through loans or technical assistance, is helping that local business. We have other programs where we directly assist businesses and tribes, but all of the programs are organized in a way that David's shop manages the intermediary program. So any questions, thoughts, comments? All right, we are going to shift the gears then. So get ready to hear the grinding of the clutch. Because we're now going to talk about becoming an approved lender under two different programs. We'll start with the OneRD Loan Guarantee Program, which actually is an umbrella for 4 separate programs. And then we'll get into the 502 process. And obviously, most of you, I shouldn't say obviously, but many of you are non-regulated lenders. So we'll talk specifically about that. Because the process is different when you're unregulated compared to a regulated lender like a bank or a credit union. So without further ado, back to you, David.
Thank you, and thank you for letting me take a drink of water. I've kind of been doing that, but basically we implemented OneRD October 1st of 2020. There's a specific application process for non-regulated lenders, which CDFI lenders are. But we also, with Ted's assistance and Office of Tribal Relations, put in the OneRD provision section regarding entities who only make loans on tribal lands. If you want to look at the regulation, it's in 7 CFR 5001-130. Next slide. The non-regulated lenders, you need to apply to become an approved lender to receive a guarantee under OneRD. That one application gets you into the B&I program, community facilities, and the water and environmental programs. All 3 of those guaranteed loan programs. It also covers REAP, the Rural Energy for America program. We consider that a business program as well, but lenders under REAP program as well. So really 4 programs. When we approve a non-regulated lender, it is for a term of 5 years. That 5-year term, you can also be renewed as an approved lender. Minimum requirement, you got to have the legal authority to operate a lending program, be financially sound. In other words, when we're looking at non-regulated, do you have a 10% equity in your business? Do you have audit and control systems to evaluate and monitor a loan and your loan program? Next. So 130D, D as in David, basically is the provisions for lenders who only want to operate on tribal trust lands. Next slide. And there are some differences in here, and what we've done to there is to make it easier for you to meet the requirements. The requirements, say you have to meet paragraph C1 of this section, but it also says that you can reduce the loan origination requirements of C1 to little i's, to Romanet 2. Basically, lenders who are loaning across the country or in states and not on tribal lands, they have to have a record of making at least 5 commercial loans for a total of $1 million over each of the last 3 years, and have a delinquency rate 6% or less, and not have losses in more than 3% on their commercial loans that they've done over that last 3 years. So for lenders, non-regulated lenders only on tribal lands, we can reduce those loan origination parameters. And you tell us, what your performance is, so we don't have to abide by that. There are a lot of lenders out there that do great work on tribal lands, and they may only make $500,000 to $600,000 of loans a year. So we wanted to make sure that you had the ability to become an approved lender if you're going to be staying on tribal lands. Next.
David, I just want to make a clarification. I guess I'll do it through a question so I don't say something that I regret. But so an entity that would apply for this, could they make loans off tribal trust lands and on tribal trust lands and be approved for just making loans on tribal trust lands, or what happens? Because most Native CDFIs do both.
Yeah, most of them do both. If you're going to do both, you have to meet that provision of C1 Romanet 2 with your delinquency percentage and doing $1 million of loans over the last 3 years, et cetera. You have to make a declaration that you're only going to be making loans on tribal lands if you want to have the reduction in the loan origination requirements from your history.
That would be for the approved, for being able to get a guarantee on it. They could do other
to be
loans.
able to get a guarantee on the loan.
They could
right.
do other loans from their regular
portfolio. Yeah, they can do other loans. But
anybody.
Yeah, if you only want a guarantee for your loans on tribal trust lands only, you can apply for that.
Okay, thanks.
Yeah, we don't want to prohibit anyone's lending range.
It will be a little bit prohibitive with the guarantee, but the point is to drive the extra loans. Capital to tribal trust lands. That's why that clarification is
right. And then the slide, if you want to know more about the OneRD guarantee, just go into rd.usda.gov and go from there. So, but again, that's a major change in there. We know CDFI lenders are good lenders. They're overseen by Department of Treasury. From there, so you have some certain qualifications you have to do to meet the CDFI requirements, but we encourage you to apply. It's all made through one area now in the Innovation Center. There's a credit risk officer who reviews all the applications from there. So we encourage you to apply.
The reason we're doing this specific outreach and for the 502 guarantee is we'd love to see some folks come in and ask us for that special consideration. To date, I don't think anyone has. To date, we don't have a tribal unregulated lender in either OneRD or the 502 Guaranteed Program. So we'll get to the 502 Guaranteed Program next, which isn't under the umbrella. But another thing you might be thinking about is which of those programs you might more easily use. I think the REAP program probably would be the smallest amount of capital needed to help finance like on business or on farm solar, for instance. The BNI program is probably one, the Business and Industry Loan Guarantee Program is probably one that's most often used. There is no minimum loan requirement in BNI, but I will say just the cost of doing that guarantee, especially with for-profit lenders, usually is for larger loans. So if your CDFI is looking at some larger loans, maybe to tribal institutions rather than tribal member businesses, that could be a space where it could be beneficial. And once again, if you're only interested in one of those programs, and there's water and waste and community facilities as well, you get all four with one approval. So you're approved for those four programs with one process, which is what we went through for 2 years leading up to the issuance of that OneRD rule, which was meant to make it easier for lenders of all types to use a range of RD programs for their customer needs. So any questions or thoughts on that before we transition into Kendra's presentation on 502, the single family housing program? I'm not seeing anything in the chat, so I think we're good for now. David, thank you very much. You can stay online, but we'll hand it over to Kendra now. And
I'll stay online.
You can do the same with me, Kendra. Just let me know which slide you want to move on to when you're ready.
Okay, that sounds great. Thanks so much for having me on here today. I'm going to take this opportunity to just go over the criteria of what we would need you to do if you're interested in becoming an approved lender with our single family housing guaranteed loan program. Unfortunately, due to some technical difficulties, I'm going to have to turn off my video so I can see the slide presentation with my notes. I'm not multifaceted like David and Ted, but I hope that that's okay with everyone. And then Ted's going to assist with the slides for me. Okay, give me just 1 second. All right, so to become an approved lender with our guaranteed loan program, it provides lending opportunities to lenders that can expand your business to a multitude of borrowers that without a guarantee you would not be able to possibly assist. So through this presentation, it'll highlight the key requirements and the steps for approval into this lending program, which lends up to 100% of the appraised value. So on slide 3, we will look at a lender definition. So a lender is an entity that originates, services, or holds a loan guaranteed by our agency. Handbook Chapter 3 defines a lender as such. And once the agency has approved the lender, it can participate in the program as long as it maintains the standards and continues to follow all of the program requirements. Let's see, so on slide 4, what is the lender approval criteria? The approval criteria from another recognized source to be a state housing finance agency. If you are a U.S. Department of Housing and Urban Development, Federal Housing Administration, if you are approved for the Government National Mortgage Association, Ginnie Mae, if you're approved through the United States Department of Veterans Affairs for VA loans, or through Fannie or Freddie Mac. That would be considered you having an approved, being approved lender that you could apply to be a guaranteed lender through our program. Okay, on slide 5, approval by demonstrated ability. You can also get approval to be an approved lender with our program through demonstrated ability. So if you have a summary of residential mortgage lending activity for us to review, if you have written criteria that outlines your policies and procedures that you follow when you're originating, underwriting, and closing a residential mortgage loan, or if you have evidence that the lender is has experienced loan underwriting on staff.
Kendra, we got our first question.
Okay.
I don't know if this is on a slide or not, but the question is, if an entity is an approved NMLS sponsor and registered mortgage licensee, does that qualify as an approved lender?
You also have to be approved through one of those entities that we went through on, I think it was slide 4. So you would need to have approval with the State Housing Finance Agency, the U.S. Department of Housing and Urban Development, FHA, Ginnie Mae, the VA, Fannie, or Freddie Mac.
Or through this demonstrated ability
Or
slide?
through this demonstrated ability, yes, for us to review. And you would include that criteria showing your approval with other entities as well. So I believe that takes us back to slide 7. What you would do for the additional requirements to show that demonstrated ability is you're going to provide us with that written criteria regarding your loan policies and procedures. You're going to provide us evidence of a written plan that you have with the lender contracts for escrow services to escrow for taxes and insurance, because that is a requirement of our program. And you would also provide evidence that you as the lender have serviced single-family residential mortgage loans in the year before applying for our agency approval. So you've had to have your you have had to have served for at least 1 year residential mortgage loans before applying to our program. Slide 8. You will also provide documentation that federal oversight is being provided by one of the following systems. So you have to show that you are being you do have federal oversight of your Federal Reserve System, the Office of the Comptroller of Currency, Federal FDIC, Federal Deposit Insurance Corporation, National Credit Union Administration, or the Federal Housing Finance Board, regulating lenders with the Federal Home Loan Bank System. So one or more of those must be providing you federal oversight. Also, if you have a Farm Credit System institution or lender that's participating in certain USDA programs, you are eligible to participate in the Single Family Housing Guaranteed Loan Program. So if you are already an approved lender in the Rural Housing Service, your Rural Business Cooperative Development Services, if you've been an approved lender through the Rural Utilities Service or through the Farm Service Agencies, through any of their guaranteed loan programs, you need to show that you have an active lender agreement on file. So that would also provide evidence of support for approval through the Guaranteed Loan Program. Okay, slide 10, your lender approval criteria. If a lender does not meet the requirements for agency approval as a lender, they may participate in the program as an agent of a lender that has been approved. So if for some reason you do not get approved to participate in that program, you would be allowed to participate under an agent that has been approved. The approved lender must designate the agent in writing and state the functions that you as a lender performing under them would perform on their behalf. So will you just originate? Will you underwrite and originate? Will you service? So they need to specify what functions you will perform. The agent is authorized to originate and close the loan in their name as long as it was reviewed and approved by the lender and is transferred to the lender immediately upon closing and prior to the issuance of the loan note guarantee. The lender is approved by Rural Development and will be responsible for ensuring that its agent's origination, underwriting, and closing activities are done in accordance with the agency standards. And the conditional commitment and the loan note guaranteed will be issued in the name of the approved lender. So basically, you can participate in the program under that approved lender, but that approved lender will need to basically verify that everything has been done in accordance with their standards and ours. Okay, so if you wish to make application to become an approved lender under the Single Family Housing Guaranteed Loan Program, you are going to want to submit the completed and executed agreement for participation in Single Family Housing Guaranteed Insured Loan Programs of the United States government. Which is the RD Form 355516, along with all of the documentation that is listed on the lender approved checklist, which is found in Chapter 3 of our handbook. When you are assembling your application, you're going to want to follow that attachment 3A, which is the lender approval checklist, and you're going to want to assemble the documents in the order that it's listed on the checklist. Make sure that your application is complete and that the documentation that you're providing to us is accurate. Once your application is complete, you're going to want to submit it to the Quality Assurance and Lender Oversight Team. And we do have the email address available on our website. Next slide.
We got our first question. And it seems like the slides are sort of advancing on their own, so I'm trying to go back as that happens. So if you see me going backwards in the slide transition, you just know I'm trying to manage that as we go. The question is, can loans be made on trust land? The answer is yes.
Yes.
And very few, if any, loans historically have been done through the approved lenders. So I think there's ample space for CDFIs, native CDFIs specifically, to become agents and to go through that process of becoming an approved lender. You will find many 502 guaranteed approved lenders that are working near your reservation and maybe serving some of your tribal members, and even on the reservation on those fee sample parcels. But we haven't seen lenders that are approved generally move into that space, I think, for a couple of different reasons. One, as everyone knows, those loans are a little harder. And two, the HUD 184 program for tribal members is dominant in that space. So we want our program to complement that. And part of the reason we're doing this outreach is to figure out what opportunities there might be for native CDFIs to become agents. And as you'll see on a later slide, we're also just issued a proposed rule for some new requirements for unregulated, unsupervised lenders, which Kendra will get to in just a moment. Is a certified TSR required? Of course, just like any loan that we would do on tribal trust land, a lender is going to secure that property however they might. And the way that mortgage is recorded is through a title status report. So I don't think there's any way to get around loans on tribal trust land without that TSR when you're originating the loan, and then also to record that mortgage on the back end. So I'll leave it at that for now, and we'll answer more questions when we get them. So I'll go on to the next slide. Thanks, Kendra.
No problem. Okay, so I believe we are on, yes, agency review, slide 12. So after the agency completes the review of the lender's application, a pre-approval or denial with appeal rights will be issued to the lender. If the lender meets the criteria for an approved lender and provides the supporting documentation as outlined in the attachment that we discussed on the last slide, the agency will issue an approval notice for the lender. Final approval is dependent on the lender and all origination and underwriting staff involved with the Single Family Housing Guaranteed Loan Program, completing mandatory training. So once you have your approval notice issued to you, final approval will be dependent on completing training that we have available, and we provide you all of the links to that training. We have actually very good training site that's broken down and allows the lenders and their staff to be very familiar with our program. And we also offer one-on-one training, live virtual training to any lender who requests it. The purpose of the training is to provide an overview of the guaranteed program objectives, lender responsibilities, required documentation, and then how to obtain your loan note guarantee after closing. Lenders may utilize live training provided by agency staff or utilize the recorded training modules that's available on our USDA linked training website. And then upon receipt of your executed training certification, the agency will forward the lender a copy of the executed 3555-16 notifying you of the final approval and your participation in the Single Family Housing Guaranteed Loan Program. And then lastly, lender approval files will be maintained and retained in accordance to Chapter 12 of our handbook 1-3555. Next slide.
Just trying to come off mute. I think I wanted to add one thing just about this process. We don't re-underwrite the loans. We're making sure that the lender is meeting the criteria needed to be issued that guarantee of that certificate of guarantee for the loans. So when it comes to TSRs, we're not going to be necessarily looking over your shoulder, but you're going to have to show that that loan is adequately securitized. And part of that is to make sure that that parcel of land, that home site, doesn't have any other encumbrances against it, which is what that origination TSR does. So know that we're not going to be deep into your business. That's not the way this program works, but you'll have to meet the requirements to get that guarantee.
That is correct. I mean, that is one of the reasons why we require you to provide us with the documentation listed on that checklist with your application. We are not the underwriter. Our lenders underwrite the loans when you submit them to us for the conditional commitment and then the loan note guarantee. All we are doing is reviewing the lender's work. We want to make sure that you have met our requirements and regulations through your due diligence, and should for whatever reason the loan go into default and you would come back to us for that guarantee, that's when you're going to want to ensure that you have all of the required documentation that we provide you, and with the knowledge and the training of that, such as your TSRs, to make sure that we can indeed give you the guarantee on that defaulted loan. So under slide 13, yes, lender responsibility. The lender is responsible for processing, servicing the loan. You may use a third-party originator, such as agents or correspondents, to carry out any of those responsibilities. We do have some lenders that strictly originate and then sell the loans. We do allow that as well. We have some lenders that that service and originate. So, however you complete the information on your lender application is what we will look at for approval. Lenders are fully responsible for their own actions and the actions of those acting on their behalf. So if you have a servicer that you are sending out those servicing duties, you want to make sure that they are, you're responsible for those actions and making sure they're establishing escrow accounts and paying taxes and insurance on time. Lenders must follow the Single Family Housing Guaranteed Loan Program guidelines as outlined in Chapter 4 of our handbook. The next slide is the USDA proposed rule for lender financial and participation requirements. So there is on June 9th, 2021, a proposed rule that was published in the Federal Register. that is proposing to update the requirements for federally supervised lenders to establish the minimum net worth and experience requirements for non-supervised lenders and amend the approved lender participation requirements. The information can be found at that link. Comments to the proposed changes may be submitted via the federal e-rulemaking portal at the link that we provided, regulations.gov. So this is a published proposed rule only. If you would like to review and make comment, please do so by accessing the link. As of right now, we have no further information available on the financial and participation requirements at this time, since it is a proposed rule. And then lastly, last slide, if you are interested in becoming a guaranteed lender, we do ask you to reach out to our lender oversight team. That is their email address, and they can definitely walk you through the process and provide you with any more detailed information that you may need. And that pretty much sums up my my presentation for the day.
Ted, you're still muted.
I couldn't get off mute. Now I am. So there was this other additional slides, which will be part of your handout. Kendra, I was going to try to go to the proposed rule, how it's been published, and show folks that next, because I can pull up those requirements as they're stated in the proposed rule, which folks can comment on, because there are some financial criteria in there, which the agency is interested in hearing from Native CDFIs specifically about those. The way a proposed rule works is we put proposed rules or parameters out there for any given program. The public, including tribes and Native CDFIs, have a chance to comment on those. And then we take those into consideration and either move towards an interim final or a final rule after those comments are taken in consideration. So it's a very first initial step, and there's time not only to make formal comment, but for the agency to take those comments into consideration and to act accordingly. So I'll open it up for questions. It's going to take me just a sec to try to open up that guaranteed for the proposed rule and get that shared. But love to hear some questions. I don't see anything in the chat. Do you see anything in the chat, Linnell?
Nothing in the chat right now.
Anybody want to come off mute or end off, turn the video on and ask a question or add a comment?
Ted, this is Dave. I'll just come back on and just kind of reiterate, what Kendra was talking about as it relates to the guaranteed loans. And when we're looking at that, we're not looking to underwrite the loans for you. We're looking to look at your underwriting and make sure you've done your due diligence in those options. So you make, especially as it relates to B&I and the water and waste community facilities, Energy for America program, we're looking to see that the projects are eligible, the borrower is eligible, that you've done your credit analysis of the borrower, but we don't tell you what the interest rate should be or what the loan term should be, especially when we get into the business lending arena. Part of what OneRD did for the business and industry program is it removed a lot of the required maturity dates for different type of loan purposes. Used to be that you could only loan up to 15 years for equipment. Now it's even based on the life expectancy of the collateral that you're taking. So depending on how much risk you want to take on the amortization from there, but you make a recommendation to us. We're not telling you what your maturity date should be. So you found something, Ted.
Yeah, can you see that? So this is the part of the proposed rule that talks about minimum net worth requirements for non-supervised lenders. So the part of the rule that will be amended is that part of the regulation. And the agency proposes to amend that subpart to reflect that non-supervised lenders must have a minimum adjusted net worth of $250,000 or at least $50,000 in working capital plus 1% of the total volume in excess of $25 million in guaranteed loans originated. So that probably is not going to be an issue because I don't know if any native CDFI is going to get to that $25 million limit. So the two critical fiscal tests in the proposed rule to look at are the ones I've highlighted there. It goes on to explain that in the rule, and then you can see the actual language that we're suggesting and how the regulation will be changed. To me, that doesn't seem excessively high, but I wonder what the native CDFIs might think. You don't have to comment now. You could comment through OWISTA, you could comment through the native CDFI network, or you could comment on your own or have the tribe comment. You can comment as an individual, as a taxpayer and a citizen, or you can comment as an employee or an administrator of a CDFI. So it truly is a public comment period. So I would encourage folks to look at that, to consider it, and to make comment. And once again, Kendra, comments are due right here before August 9th, on or before August 9th. So a little over 5-6 weeks to go until that comment period closes. So if you have any questions about that, you can follow up with us. I will add one thing about our single family housing programs, which some of you may or may not know. About 18 months ago, I think it is now, our single family housing guaranteed staff became a national office staff. So Kendra doesn't report to a state office, nor do any of our guaranteed rural housing staff anymore. So the folks that you would work with on our single family housing direct program, they're still in the state offices. And many of the guaranteed specialists are spread out through the country. They didn't have to move, but their organizational structure flows through the national office up to the same deputy administrator, Kathy Glover, who some of you have met and know. She's our career SES person that runs both the direct and guaranteed programs. But just know that our guaranteed specialists work in a centralized fashion through a chain of command that reports back to DC, and it's not part of the state offices anymore. And I think that was January of 2020 or 2019 when that happened.
February of 2020.
February of 2020. So that's still pretty new, but it allows us to share work and to move files around in a way that balances workload easier across the country. So it's been very effective so far, but just know there's a little bit of a different contact protocol in that agency. And you can always reach out to me directly as well. I'll put my contact information in the chat and ask Dave and Kendra to do that before we log off. But that's all we have for you today. We've got about 6 more minutes left. If anyone would like to ask a question or share a comment either about the intermediary programs that we covered first or the guaranteed loan approval process to become an approved lender, I should say. I'm hearing none. So I'm going to type quickly before the recording is stopped and put my contact information in the chat so you have that. You definitely do not have to go through me to contact any of our staff, but know that if you want to, you're more than welcome to contact me at any time about anything we covered today or any questions about rural development that you might have. Andrew, do you want to say anything in closing?
If anyone has any questions, feel free. I put my email in the chat. Feel free to reach out. And if you have any questions about what we discussed today, or if you're interested in becoming an approved lender, please let us know.
David?
I appreciate the opportunity to talk to you about our programs, what we have here. I did put my email address in there, and if I had a little bit of time, which I will have now, put my phone number in there as well. So look forward to hearing from all of you.
Thank you to David. Thank you to Kendra. Thanks all of you for joining. Linnell, is there any housekeeping you need to do from the OWISTA side?
Just a quick announcement. You do have a 30-minute break. We go back into our final plenary of the day at 3 o'clock. So we look forward to seeing you there. And I too, from OWISTA, would like to extend our appreciation to Ted for facilitating this awesome informative session with David and Kendra. So thank you very much. And we will share out your contact information, and feel free to reach out with any questions. So we'll see you soon. Thank you.
Very good. Thank you very
Thanks
much.
so much. See you next time.
Bye.